Welcome, everybody. Good afternoon, and thanks for joining us. My name is Manos Cito. I'm the co-owner and founder of BACK9 Retirement Solutions here in Wall, New Jersey. Before we get going, I'd like to start with some housekeeping items. In our new world of technology and COVID, I imagine that most of us are somewhat familiar with the technology, but just to make sure that we're all on the same page. Everybody except the presenters will be muted. There are features for us to interact and ask questions, and I'll go over those in a moment. There is no video of you guys. The video is just of the two presenters, so there's no privacy issues there. We also have this whole presentation being recorded, so we will have the slides, the presentation sent out post presentation probably tomorrow. But the slides will not be included for compliance purposes. The Q&A, if you have a question, we have two choices. You can click on the Q&A icon, and that Q&A icon is personal. It is not public, so nobody will know who is asking the questions, and nobody else will see your questions. If you want to make a public comment or a question, you can use the chat function. The chat is public, and it will be identifying who is asking that particular question. Throughout the presentation, we will be having some pop-up polls. They're not quizzes, you can't fail, but they're questions to help us understand your needs and goals and your thoughts about retirement planning and taxes. There's no right or wrong answers, and they're only a multiple choice, takes 2 seconds. You'll see the results of the survey each time we ask one. There will also be a periodic pop-up that is going to allow you to schedule a phone conversation with one of us, Manos or Joel. We'll introduce Joel in a moment, my partner. There's a lot of interesting and very important information included in this presentation. So there might be some questions that you would have that would be better answered on a direct call, so that we're not talking about personal situations in a public setting. There will also be Q&A. The Q&A, we're going to ask for you to type in your questions as you think of them. Our marketing manager and director, Kevin, is going to be monitoring those questions, and we will address them and answer them at the end of the presentation. For those that stay on with us till the end of the presentation, we will also be offering a special offer at the end called the BACK9 Grip. We'll talk more about that in a moment. And for those of you that signed up, you may also remember we have a second session scheduled. That is for tomorrow, Thursday, the 15th of October at 6 p.m. Eastern Time. So a little bit about BACK9 very quickly. We're a unique and boutique retirement income planning firm here in Wall. We specialize in helping people on the back nine of their retirement, not their accumulation phase, but their distribution phase. So we have specialized expertise, specialized technology to help a client make the turn from the front nine of the retirement to the back nine of the retirement. We'll talk more about that in a moment, and we'll introduce Joel as he goes through some of the slides. We're going to alternate our slides, and then you'll see at the end, we'll talk about what we're going to offer you and also answer your questions. So if there's nothing at the moment, I will get going. So the first topic that we're going to talk about is the lovely market volatility that we're experiencing. We experiencing during the COVID breakout initial in February, March, April. The recovery that we're seeing since then, but the volatility is definitely continuing during the summer and now into the fall. As you can see, we're going to talk about the impact of COVID. We're going to talk about the CARES Act and the stimulus bills, future tax considerations, and economic uncertainty, unemployment, and global recession. We did experienced a decline in the market during the first quarter, affected mostly by COVID. The Dow lost approximately 23%, the S&P 20, and the potential second quarter unemployment was down 32%. So you can see there was an immediate and drastic impact of COVID on the markets and the market volatility, as well as the economy and the unemployment pictures. How long will it last? Well, if we all knew that, we wouldn't be sitting here probably. This is uncharted territory for all of us. It's impossible to predict when it may end and when the market and the economies will recover fully, and how we will return to what might be the new normal. The financial crisis in 2007 and the tech bubble in 2007 were also triggered by unprecedented situations, but the markets ultimately recovered and did very well in the long run, as they have historically done after every bull market that we've experienced in history. In fact, the average bull market lasts approximately 13 months with a total of, bear market lasts approximately 13 months with a total loss of about 30%. The market is then averaged by a 22-month recovery, and we just can't predict when this will happen. But if history is any guide, the market will recover at some point. And until then, if we stay calm, explore our options, make sure we have a plan, mitigate our risk, and participate in the future recovery, we should all be just fine. I can help you analyze all your possible options and implement a strategy that we'll be talking about on the future slides. For those of you who have years until retirement, you have time to participate in a market recovery and build your assets. But what about those who are retiring soon? Or those who recently retired and need to start taking income from their accumulated portfolios? You're vulnerable to a specific kind of risk that could impact your retirement income and your financial stability. The terminology that we use for that is, is sequence of return risk. It's not the returns that you receive, it's the returns that you actually, when you get them. It's not whether you're getting 8% a year on the upside and then 8% a year on the downside. It's how it's mixed. We know the averages over time. We just know the sequence. So if you're retiring in a bull market, you can see in the examples on the screen, if Dave retires in 1998 during the bull market. Remember, the 90s was the peak of the tech bull market. He retires with $500,000 in invested money in an S&P index. Decides to withdraw $30,000 a year for his retirement income. Now, Ann has almost the exact same strategy, but she's going to retire also with $500 in the S&P, and she will also take $30,000 in her income. The only difference is that Ann is retiring 2 years later in 2000, which is the start of the bear market. We're going to see the effect of that on the next slide. Here's the bull market and the bear market, and what happens when you're retiring in either of those scenarios, depicted by the dark line for Dave and the light gray line for Ann. So another way on this chart to depict the results is, if you see Dave at the end of 2002 has taken his income, he still has a balance of $343,000. But since Ann started 2 years later, she's taken the same $30,000, but she's down to $238,457. The effect is that the 3 of her 4 years were negative returns, where Dave had 2 positive returns in the beginning, then 3 negative returns. So sequence of return risk is a risk that most people don't think about. Everybody knows about volatility. Everybody knows about inflation, economy, healthcare risks, so on, longevity risk. But sequence of return risk is extremely important and can be managed with proper planning. I'm going to turn it over to Joel. He'll introduce himself and go over the next few slides with you.
Hi, folks. Joel Russo here, managing partner, co-owner with Manos. Thank you all for attending today. As Manos had mentioned, protecting income against market volatility is one of the biggest things we do here. And unfortunately, we can't predict when markets will recover, how long, from year to year, how long it will take for them to recover. We can only make, in the industry, we can only make estimates as to how those things happen. So there's no right time, someone picking their right time to retire may not be, as in the example of Ann, may not be the right time to retire. And there might be some other things that need to happen to help one out with their retirement income so that it lasts as long as they do. One option is some of the vehicles that we use can guarantee a floor income so that income comes in no matter what kind of environment is out there market-wise. That protects against market volatility, and the income is consistent no matter what. So we help folks explore those options, those different tools that we use. So right now we're going to get into, before we get into the main presentation, we're going to get into a little bit about the Secure Act. You might see on your screen that you have the opportunity to schedule one-on-one time with either myself or Manos. You can click the Schedule Now button. That'll show up a couple of times throughout our presentation, so that if anybody would like to take some time outside of the environment here on our webinar, we'll be happy to answer your questions. So I'm sure a lot of you folks, depending upon where you get your information from, be it the internet, be it the news, or anywhere in between, the Secure Act was happened to us last December. Secure standing for Setting Every Community Up for Retirement Enhancement, which is a mouthful, and that's why we have the acronym Secure Act. It includes a wide range of retirement law changes and aimed at boosting retirement savings. We're not going to get into every point, but we're going to get into a couple of the things and highlights the things that we feel are important that you need to know. One of the things you can see here on your screen is changes in the RMD age from 70 and a half to 72. So that took effect as of this year. Everybody, again, a little outside the box, RMDs are not required this year because of the COVID pandemic. If you are already taking your RMDs, meaning you've hit 70 and a half, started your RMDs, you cannot then stop and wait till 72 to take your next one, albeit that you again can stave off RMDs for this year only. So the other part of the Secure Act is you can still now contribute to an IRA past the age of 70 and a half, where we weren't able to do that before. The Secure Act also repeals a lot of the age limits on things, and as long as you have earned income, you can keep making those contributions. RMDs are based on beneficiary life expectancy or withdrawal of funds in 5 years. So when we go, they've taken away the stretch option for being able to withdraw funds from a qualified account. Other than a spouse can receive these funds, but everybody else that is non-spousal must take it within actually a 10-year period now. So the Secure Act also made a big change in the way of non-spousal beneficiaries. Let's assume you have an IRA that you want to leave to your children. You name them as beneficiaries and then pass away. They're able to receive the funds. Under the old law, they had a few options, as I mentioned, stretch and so forth. However, remember, death benefits for traditional IRAs are taxed as ordinary income. Taking it all at once because of what may be a sizable IRA could be a problem. It can push beneficiaries into higher tax brackets. So you want to make sure that that's taken care of in advance. So instead of non-spousal beneficiaries can take advantage of one of two options. One was the stretch back, which is no longer. And they usually led to a modest annual distribution, of course, which didn't do much for taxes to most people. But again, that's been taken away. So the Secure Act also changed the options for non-spousal beneficiaries. And let's take a look. So again, as I mentioned, one of the tax planning options to withdraw funds within 10 years. So you could take it in 1 year, take it over 10 years, or take it at the very end of 10 years, knowing what your tax implications may be. Lifetime income reporting. 401k participation for part-time employees, and annuities as a strategy. So now what you're going to be seeing, if any of you are still at work, what will be coming into the marketplace are strategies for 401ks to act like pension plans and have a lifetime income strategy to them. So here, looking at our what does your Secure Act mean for your retirement? Assets may last longer. Of course, people are living longer. Sophisticated tax planning needs to be taken a look at. I think if we can throw up a question here as to what folks think about taxes. Kevin, if you can throw that up. We have a poll question that we'd like to ask. Also, more income planning tools are available these days. So you want to have a Secure Act review on your retirement strategy, since things have just recently changed, and of course, being in this pandemic. All right, there we go. Anyone can either answer no or yes to that. No one else will see the answers, so don't worry, or you can do it later. All right. So what we'll discuss now in the main body of our webinar is Tax Cuts and Job Act of 2017, the current retirement landscape, 3 common mistakes a lot of folks make in retirement or don't think about correctly in retirement, and tips and strategies to manage your exposure through retirement. Okay, tax first thing. So the Tax Cuts and Job Act of 2017, it supposedly reduced rates, increased standard deductions, and eliminated a lot of deductions, credits, and exemptions. A lot of you may have already felt that, having done taxes for this past year. And here we show what the 2020 income levels for the new tax rate filings looks like. So we still have seven brackets for taxes, and everyone can see what that looks like for both single and married filing jointly. All right, so as a standard deduction, here we have a single person previously would be able to deduct $6,350. The new deduction for a single filer is $12,000, and for 2020 they have enhanced that to $12,400. For married folks filing jointly, it was previously at $12,700. Now we are at $24,000, and bump up in 2020 to $24,800. So that has changed things as to how folks can take deductions and so forth. Sometimes using the standard deduction may be better, sometimes not. It has the Tax and Jobs Act of 2017 has eliminated the $4,150 per person exemption. And the current retirement landscape, Manos, I believe you're going to take that over.
I'm back.
You're back.
Before I start, I'd like to take another poll. Read quickly here about taxes. I think it clicked on the wrong one. It did. I did. Sorry. Do we see that poll about taxes? All right. Let's continue. So some of the 2 major challenges in our retirement landscape that have changed over the years is our longevity has increased considerably. We're living longer and healthier into our retirement years. Our projected number of years in retirement is also expanded quite a bit. When Social Security was first introduced, the amount of years expected for Social Security to help with retirement was probably a third of what it is today. One of the reasons that Social Security is, I don't want to say rumored, but is talked about running out of money at some point, is because it is lasting for longer lifespans, and therefore the projections of contributions were not accurate over time. The other major issue with retirement is very few companies have the old-fashioned pensions available to their employees, where when you retire, you get a percentage of your last year's income that will last either for your life and or your spouse's life, and in some form. There's various options. Those pensions, as we know, has been replaced by the 401k plan. One of the things we like to say about 401k is it's not a plan, even though it's called a 401k plan. It's a product. So the product is set up to save for retirement with a tax advantaged features. However, it is not a plan. And we'll talk a little bit more of that in a moment. What taxes could you face in retirement? We all know about income taxes. Our income taxes are obviously quite high and expected to go a little bit higher. We are stimulating the economy with all these different packages that are going to, they have to be paid for, and they cost a lot of money. So one of the ways that we're expecting is our income taxes to rise. I think everybody would agree with that. Our second thing is capital gains. Capital gains on asset appreciation is also probably a major part of a lot of people's retirement savings, and could be substantial if the gains are over a long period of time. AMT, alternative minimum tax. If you're in it, you know about it. If you're not, you're lucky. It's not a great tax. We try to avoid being an AMT if at all possible. That is also a situation that is being reviewed, and hopefully will be updated to reflect everybody's new income and the new economies and so forth, and the new deduction rules. SALT, state and local taxes. State and local taxes, especially here in New Jersey. As we know, the governments are spending a lot of money on stimulus for COVID. They're spending a lot of money on everything else for infrastructure. Where is it going to come from? It's going to come from our taxes. We've seen gasoline taxes rise recently. We have seen potential sin taxes rise, liquor, tobacco, and so forth. So I think we all agree that our taxes are not going to go down. They're going to go up. Taxes go up and down sort of in conjunction with other features like deductions. So where the rates might be low, they're going to take away deductions. If the rates go up, they're going to add deductions, theoretically. So it's not just the rate of your income tax, but it's also what the other allowances are for deductions. So there's three common mistakes in retirement. We're going to go through them very quickly here. One of the number one mistake is relying solely on your taxable income to fund your retirement. So taxable income being from your 401k or IRAs, those incomes are taxed as ordinary income, not capital gains, because they were never taxed going in. They were either deducted or pre-taxed rather. They grew tax deferred, and now they want their money back. The government wants their money back in form of ordinary income taxes. The other major mistake is not planning for taxes on Social Security income. There's always a confusion as to how is my Social Security income taxed. There is a formula we're going to go through in a moment to show you how it's determined what your overall gross income is, your taxable income, and then how your Social Security is affected by that. And the third mistake in retirement is failing to develop a tax-efficient income source. There are a few income sources that are tax-efficient. The IRA and the 401k are obviously not one of them. The Roth IRA and some life insurance products are tax efficient. Muni bonds are tax efficient. So we'll discuss those in a little bit more detail in a moment. So to rely on taxable income as a retirement plan, we talked about the 401k goes in pre-tax contributions. The IRA goes in after tax, but is tax deductible. They both grow tax deferred. But when they come out, they're taxed as ordinary income, as we mentioned. This does not hold true for a Roth. We'll come back to the Roth in a moment. Not true necessarily for life insurance. We'll come back to that as well. Second mistake, the benefit amount of your Social Security, what it is based on. It's based on your career earnings at the age when you file. So the benefit amount is calculated when you file. If you file at full retirement age, for some of us that's 66, for some it's 67, that is your base case. If you file prior to full retirement age, that base case amount is reduced by the amount of time you're claiming prior to full retirement age. And if you postpone until after retirement age, your retirement amount is going to increase by currently 8% a year with any inflation adjustments that are determined year by year. So if you can wait until age 70, your income base will go up by 8% plus inflation with no market risk. It's very hard to duplicate for any financial advisor or any investment strategy that we know of, especially the risk side of that. So Social Security taxation is based on your combined income. And your combined income is defined by your adjusted gross income that you may earn through any kind of employment, your non-taxable interest income, which is stuff from like muni bonds. Let me go back. Your adjusted gross income also includes income from investments that are sold. So if you're selling stock, paying capital gains, or if you're selling bonds and paying interest income, that's all part of your adjusted gross income. Plus the non-taxable interest, plus half of your Social Security benefit. So if you're making $2,000 a month on Social Security, half of that is subject to the formula to calculate your combined income. Once you have your combined income, the amount of tax is broken down as follows. So if you're a single filer and your combined income is up to $25,000, there's no tax on the Social Security. If it's 25 to 34, 50% of your Social Security amount will be taxed. And over 34, up to 85% will be taxed. We saw the Social Security taxation start at 0. And over the years, it's gone higher to 50, and now it's to 80, up to 85%. So it's definitely a consideration we need to plan around. Joint filers, your income levels are a little bit higher, 32 for non-taxed, 44 for up to 50, and 85 for more than 44. As an example, we have John and Jane. John and Jane have an annual retirement income of $30,000 from Social Security, $40,000 from combined income, for a total of $70,000 in total retirement annual income. So what is it going to look like from a tax perspective? They have $40,000 in adjusted gross income from the retirement account distributions. They have 0 of non-taxable interest, and they have half of their $30,000, which is $15,000 in Social Security benefits. So now their combined income for tax purposes is $55,000. That leaves us with the following tax effect. They will have a combined income of $55,000, which means the total benefit is $15,000. Taxable benefit, is $15,350. That would put them in a taxable bracket of 12%.
Okay.
we're going to move back on to Joel, and he's going to take over for the next several slides.
So last mistake we have here, failing to develop a tax efficient income. And we're going to get into some of the things that Manos mentioned previously that we would get into, but there are municipal bonds, Roth IRAs, and life insurance. One of this being the final mistake or fault that a lot of folks have is the timing of retirement, and waiting until they do their first tax return to look at these tax or the tax remedies, if you will, that are available to folks. So by acting sooner rather than later, like anything else in life, you have a better opportunity to reduce your taxable income and take advantage of different strategies to do that. We're going to talk about a few of those, including municipal bonds, like I said, Roth IRAs, and life insurance. So let's move on here. Interest on municipal bonds is often tax-free. So obviously, municipal bonds, those of us that might not know what they are, they're government bonds, county, state bonds, local governments to finance the government works, like roads as an example. And we can all invest in that and receive tax-free income. You can purchase them either individually or via mutual funds. While the interest on these bonds may be tax-free, we now know from the previous slides that Manos went over that they are included in calculating Social Security combined income, the tax on Social Security. So a few things to remember on municipal bonds. Just because their interest may be tax-free doesn't mean that they're risk-free as well. They can fluctuate in value just like any other bond or security. Also, if you sell a bond and realize a capital gain, you'll pay taxes on that amount. Municipal bonds are completely tax-free. Only the interest is income tax-free. You should consider your risk tolerance, of course, when looking at these types of items. So tax-free withdrawals, Roth IRAs have become very popular and are catching up to, if you will, traditional IRAs. Tax-free withdrawals, assuming that you are over the age of 59 and a half, and the IRA's first deposit occurred at least 5 years in the past. So you needed to establish a Roth IRA 5 years ago and be over 59 and a half to have the efficient tax treatment that a Roth IRA gives us. Roth IRAs also do not have the required minimum distribution that traditional IRAs have, so you do not need to take the money out if you do not want to. It is your choice, as long as you get to decide when you want to take it out. So let's take a look at Roth contribution limits. On single and married here, we have less than $124,000 on single filers, married filers less than $196,000. The allowable contribution is $6,000 for most folks, and there is $1,000 extra for those 50 and up. So total being $7,000 allowable contribution. And the single filers and married filers from $122,000 to $138,000. And married filers from $196,000 to $2,000 and $6,000, less than $6,000 is an allowable contribution. Anything over those amounts, there is no allowable contribution to a Roth. Okay. Roth conversions, again, along with Roth IRAs themselves catching up to IRAs. One of the reasons for that is because our traditional IRAs are still in the lead. A lot of folks are looking at these Roth conversions for the simple purpose of what we're talking about today, and that's tax efficiency. So you have the opportunity to convert your current traditional IRA to a Roth. You would pay the income taxes on that converted amount in the year that you convert, and you will be able to then take tax-free withdrawals from that new Roth in retirement. So again, Roth conversion might be a great strategy for a lot of folks. It just depends on how you go about taking advantage of it and what strategy, the way that the strategy works, what makes the most sense for you. We have a poll up here. What do you think will happen to taxes in the future? I always get a chuckle out of this when we do this live. Do you think they'll be higher, they'll be lower, or they'll stay the same? I think I know what everybody's going to answer, but go ahead and take a second to do that. Answer that. And we'll move on here to life insurance. Life insurance, not our parents' life insurance, a little bit different. I mean, if some of you own permanent life insurance, tax-free income is taken from permanent life insurance in two ways. You can withdraw premiums and or take loans. The loans are very minimal. They're not like regular loans, and for that matter, our interest rate environment is so low. There are what's called wash loans, where you don't have to pay any interest on the loan. But the income tax treatment with life insurance only exists if you continue to keep that life insurance in force. Life insurance, back before Roths became very popular, life insurance was a way to actually provide a super Roth, we used to call it, where the limit for contribution, there was not the limit like there is in Roth, and you were able to get out of it the same things that you get out of Roth, meaning pay the tax on the money going in, the money grows tax deferred, and can come out tax-free ultimately for you in retirement. Again, this is a tool that we use for folks, but you need to plan for this in advance, like most of the things we've been talking about. It's not something you can do on the fly. So in the example of John and Jane with tax planning, John and Jane have an income goal of $70,000 per year. So they have Social Security benefits of $39,600. They have a converted Roth IRA of $10,000, universal life insurance policies $7,500, and taxable accounts of $12,900. So we are just taking a look. Finally, they waited until age 70 to file for Social Security, which increased their Social Security benefits to the amount of $39,600. So let's take a look here. So now with some of the tax-free strategies taken advantage of here, John and Jane's new combined income, adjusted gross income of $12,900 plus again, we kept the non-taxable interest at zero. Half of the Social Security of $19,800 comes out to a lower number of combined income at $32,700. And that has now given them a taxable benefit amount of only $350, rather than I believe the number was about $3,100 in taxable amount, without taking advantage of the insurance and Roth conversion for income. So they were able to get out the same amount of income and pay a lot less in taxes. So when you calculate taxes into into our returns, it could be a significant drag on our returns. They, again, from a tax bracket standpoint, they did not have any taxable income in the ranges that they had them before. So there was zero tax out of the 10 and 12% tax bracket, because once they took into consideration the AGI, their $13,250 of adjusted gross income, and got their standard deduction, taxable income is at zero. Lastly, other factors to consider, capital gains. Of course, we talked about rental income, business ownership, earnings from work and retirement. A lot of folks might be going back to work if that is something that needs to be done to make money, or people that own businesses might still be taking advantage of the income from those businesses. The best way to address your unique tax risk is to meet with someone, hopefully like us, that specializes in these things. Again, one of our offers is the amount of time we can spend with you over the phone. And we'll go over at the end of our webinar in a few moments some of the other ways we can take advantage of helping you out if the need be. Manos, I'm going to switch it over to you for the end of our program.
Thank you. So remember I said there was a theme early on in the 3 planning mistakes that we discussed. Does anybody remember what that theme might be? Well, you're probably right. It's failure to plan, or as Ben Franklin would say, if you fail to plan, plan to fail. We are about retirement income planning, not retirement income products. What we do is we analyze your situation. We create custom plans for our clients. That includes portfolio adjustments. That includes safety of income. That it may include estate planning and insurances like Medicare supplement and or long-term care insurance. So we're a comprehensive firm that focuses on retirement income planning. If you fail to plan to pay taxes on Social Security, you fail to develop a tax-efficient retirement income plan to pay higher income taxes. It's as simple as that. So one of the things that we get asked all the time is, if we engage with you folks, what kind of stuff can we expect to receive from meeting with Manos or Joel? So we have developed a proprietary analysis and plan that we use the acronym GRIP. The analogy obviously is the grip in golf, but GRIP standing for Guided Retirement Income Plan. What is actually a GRIP? A GRIP is a combination of 3 different analyses. One is a custom retirement income plan, not a product plan, but what kind of income and cash flow do you need and how can we achieve it? The second is a Social Security maximization analysis. That is an analysis that we do that shows the mathematical benefit of either taking early at full retirement age or waiting to 70 or any in between. What result is going to be the most dollar benefit for your family over both of your lifetimes. Now, there are over 500 claiming strategies, not just 3. That's a very big misconception. We have proprietary specialized software that will help us calculate that. It's very simple, but very effective. And our third inclusion in the GRIP is a portfolio proposal. Everybody has worked either on their own or with other financial advisors over the years, accumulating assets, contributing to their 401k or IRAs or non-qualified accounts. Their portfolios reflected their risk, your risk at the time, your goals and objectives at the time, and the fact that you had a lot of time left. What our proposals do is now adapt your portfolios to where you are in your life cycle today, at retirement or in retirement. And we should be making allocation changes to reflect your different goals, needs, and objectives. Very quickly, I am going to launch, we filmed a 30-second commercial that we've put on TV and the local channels. You've seen it. Bear with us. We are amateurs, but we had it done professionally. It just gives you a very quick 30-second look at BACK9.
Once you've completed the front 9 and made the turn, you begin the back 9.
In retirement, once you've completed the accumulation phase of your life, you make the turn and begin the distribution phase of your life.
Are you at the turn? At BACK9 Retirement Solutions, we can help you plan for the back 9 of your life.
BACK9 Retirement Solutions is a boutique specialty retirement planning firm. So before making the turn, let our retirement pros help you achieve your safe, enjoyable, and secure retirement.
So before making the turn from earning an income to replacing your paycheck, give us a call. So thank you for bearing with us on that. I think it tells a story about what we do and why we're different from a lot of the financial advisors. I know everybody's approached by financial advisors. And what we like to say is we're all financial advisors, but we all have different expertises and different skill sets. Just like the analogy we use as a doctor. You might go to a pediatrician with your child up until a certain age, but when you're 20, 30, 40, 50, the pediatrician, while still a doctor, is not the right fit. Would you go to a cardiologist for a knee replacement? Probably not. So make sure that you're talking to a financial advisor that has the expertise, skill set, and technology to address your needs in retirement, not leading up to retirement. We do have that special offer for the GRIP. If you schedule some time with us, we will go through it with you in detail. We'll do a fact finder. You can either come in person or do it on the phone or do it on a virtual call like we're on now. We are COVID compliant in the office. If you need to do it virtually, that's fine as well. And if we encourage you to visit our website, www.back9retirement.com. You'll see a lot of information on there. There's our contact information. And there's also, we'd encourage you to join our social media sites, Facebook, Twitter, and LinkedIn. With that said, thank you for coming. We will do a quick Q&A if you have time. You can stay on, and we will address the questions as they came in. So one of our first question is, I didn't reallocate my portfolio during the pandemic. Should I be doing that now? Well, absolutely. We encourage our clients to review and reallocate at least annually, more often if it's a complex situation, and more often if there's extenuating circumstances like COVID. We want to make sure you have a plan, but we also want to make sure that that plan stays on track for you, given the environment that we're in. I talked about the differentiation between BACK9 and some of the other financial advisors in the area. We put a lot of time and effort into that. That's why we're boutique. We have the resources and the expertise necessary to address your unique and different needs in retirement than they were during your accumulation years. We have another question. Does the Secure Act allow contributions to a 457B past 70 and a half like it does for a 401k? Joel, you want to tackle that since you covered the Secure Act? Joel, where'd you go? Sorry, I think we lost Joel technologically. I believe the answer on that is yes. I will come back to the person that asked it. I'm not 100% sure. 457Bs are nonprofit or government plans, and we don't see a lot of them, but we will get you back that answer. Another question is, my 33-year-old daughter is named TOD on my accounts. My understanding is that the entire account is transferred to her upon death. Does that need to take a distribution? That will depend on what type of account it is. If it is a non-qualified account, distributions are not required. If it is an IRA, it is not a TOD. An IRA, when you pass, goes to the beneficiaries listed. So there's three things that are beneficiary driven. One is a life insurance policy, 2 is a annuity, and 3 is a IRA or qualified retirement account. Non-qualified accounts could have a TOD, and there are no distribution requirements on a non-qualified account. Any other questions that come in? Please email us. You have our contact information. If you want to have a quick call with those questions that may pertain to your individual situation, please do. If you want any additional information or talk about the GRIP process, please give us a shout, and we look forward to hearing from you.